Good morning, good afternoon, good evening, and welcome back to Alpha Index, the place where we don't just talk about money, we talk about the principles behind it. We understand that true financial success isn't just about the numbers, it's about the mindset. Today, we're going to untangle a financial Gordian knot for many of you. You've heard the terms mutual funds, index funds, and ETFs. They sound similar, and they're all vehicles for investing, but their fundamental nature and purpose are profoundly different. And the real question isn't, which one is better? But, which one aligns with your principles? Before we dive in, let's revisit a core idea from our last discussion. The concept of financial DNA, your personal history, your family's relationship with money, and your formative experiences all shape how you view the world of finance. It's why some people see risk and others see opportunity. It's why some are comfortable with complexity and others seek simplicity. Keep that in mind, because today's topic is a perfect example of how different people with different financial DNAs will be drawn to different tools. Let's start with the oldest and most traditional of the three, the mutual fund. Imagine a mutual fund as a team of highly skilled chefs. You and a bunch of other people give them your money, and they use that money to buy ingredients, stocks, bonds, whatever they think will make the most delicious meal. Their job is to constantly taste, adjust, and find the best new ingredients to beat all the other chefs. This is an actively managed fund. You're paying the chef a fee, known as an expense ratio, to make these decisions for you. The principle here is delegating expertise. You trust a professional to find the best stocks, to navigate market volatility, and to actively manage your money to outperform the market. This is a powerful idea, especially for those who feel they lack the time, knowledge, or confidence to do it themselves. It's an investment in someone else's skill. However, there's a cost to this. Those chefs need to get paid, and sometimes their decisions, no matter how well-intentioned, don't beat the market. In fact, many actively managed mutual funds consistently underperform their benchmarks over the long term. This brings us to a crucial question. Is the pursuit of a small, potential gain worth the higher fee and the risk of underperformance? Now, let's talk about the index fund. This is where we shift our thinking entirely. An index fund isn't a team of chefs trying to outcook everyone else. It's a completely different philosophy. Imagine you're at a massive buffet. Instead of trying to pick out the absolute best dishes, you decide to just put a little bit of everything on your plate. You're not aiming to find the one best stock, but rather to own a small piece of the entire market. An index fund simply buys and holds every stock in a specific index, like the S&P 500, which tracks the 500 largest US companies. The principle here is not to beat the market, but to be the market. You are betting on the overall growth of the economy, on the collective genius of thousands of companies, rather than the singular genius of a few fund managers. The core idea is radical simplicity and low cost. Because there's no chef making daily decisions, the management fees are incredibly low. You're not paying for a person's judgment. You're paying for a mathematical, rules-based process. This approach is profoundly humble. It acknowledges that consistently outsmarting the market is a fool's errand for most of us. It's a strategy rooted in patience and the power of compounding over time, a principle we discussed in our last video. This brings us to the final piece of the puzzle, the ETF, or exchange traded fund. Think of an ETF as a modern, upgraded version of both the mutual fund and the index fund. An ETF can be actively managed, like a mutual fund, or it can be a passive index fund. The key difference is how you buy and sell it. A mutual fund can only be bought or sold once a day, at the end of the trading day, at a price known as the net asset value. An ETF, however, trades on an exchange, just like a regular stock. You can buy or sell it at any point during the trading day. This offers a level of flexibility and liquidity that mutual funds can't match. The ETF is a vehicle that embodies the principles of accessibility and control. It brings institutional-level diversification to the average investor with a low barrier to entry. Its structure allows for more nuanced investment strategies, from sector-specific funds to global, all-encompassing ones. So, let's summarize the principles at play here. The mutual fund is about delegating expertise. It's for the investor who wants a professional at the helm, who believes in the value of active management. The index fund is about humility and efficiency. It's for the investor who believes in the power of the broad market, who seeks simplicity, and who wants to minimize fees. And the ETF is about flexibility and accessibility. It's a modern vehicle that can house either of the other two strategies, but with the added benefit of real-time trading. The real question is not which one is best, but which one is best for you. Do you believe in the power of an expert to beat the market, or do you believe in the collective power of the market itself? Do you value a professional's judgment or the discipline of a rules-based system? Are you building a long-term empire and willing to set it and forget it? Or do you require the flexibility to trade throughout the day? The most important thing to understand is that all three are tools. And just like a hammer, a wrench, and a screwdriver, they each have a purpose. The person who understands the principles behind the tools is the one who ultimately builds the strongest foundation. We've covered a lot today. And as always, the goal here at Alpha Index isn't just to give you information, but to provoke thought, to challenge you to look beyond the surface and to understand the deeper principles that govern our financial world. If this video has given you a new perspective on these foundational investment tools, I'd ask you to do two things. First, share it with someone who might be struggling with these concepts. And second, if you haven't already, subscribe to Alpha Index. The world of finance is complex, but with the right principles, we can navigate it together. Until next time, this is Alpha Index, inviting you to master the principles, not just the numbers.